Hey, traders. Wow, that's a lot of Raghee. Let's get the screen going. All right, hey, traders, welcome to Charts and Coffee. Forgot the charts. Gosh, and I do have the coffee. All right, hope everyone is doing well. This FOMC Thursday. I know, Thursday, FOMC? Yes, normally FOMC is on Wednesday, but obviously due to the election, they pushed it out a day. Today at 2 p.m., we get the FOMC. And this really is the big event of the week, gang, because monetary policy is going to dictate what it is we can expect from bond yields, currencies, and equities in a way that reflects whether or not we're going to see rates continue to head lower or if they're going to pause. And, is pause such a bad thing? Wrong. If we're already cutting rates, why would it be an issue if the Federal Reserve pauses? Why is that potentially a bearish catalyst? Maybe a pullback type situation, not a crash. I mean, let's not get dramatic. Hopefully, people are realizing we either have a math problem to solve or we have a drama problem. 80% of the market loves the drama, right? We'll stick with the data, we'll stick with the math. And the math is that expectations based on the target rate probabilities of the Fed fund futures, which absolutely are very influential, gang. They not only reflect what you and I were all thinking, but they affect what's happening in terms of perception in the Federal Reserve as far as what we are all expecting. They know if they don't cut today, bedlam, 97.6%. But that's not really where the conversation's happening. That's done deal. Stick a fork in it. Where's the next math problem? The next math problem is, as you can see here, we go out to December. Now, these have been fluctuating wildly. Notice that the current rate is 475 to 500. We're going to get down to 450 to 475 at 2 p.m. today. But then where do we go? Interestingly enough, and these have gyrated a lot, the next lower rate, right, would be what? To move down to this area. And before, there was a time where expectations were very high and pretty much fully discounted that we would get a rate cut in November and a rate cut in December. And now this hold column at 450 to 475 is as prominent as it's been in a long time. So this is where, if you kind of map that forward into January, into March, this is what bonds were saying. Bonds are kind of calling a liar, liar, pants on fire to Powell and company, saying, we don't think you're going to keep cutting every single meeting. In fact, I think bonds might be overdoing it a little bit, but bond yields moving higher in a rate cutting cycle is out of sync. And when things are out of sync, I'm not going to say, there's a typical statement, oh, the bonds are saying something. It doesn't mean that they're a harbinger of what's going to happen, but it is very much evidence that something's not, the gears are not lined up. Right? Something has got to be clarified. So I don't believe bonds are always right. And we don't always want to say that bonds are always telling a single story. There's lots of things going. It's a very complex instrument. And I respect the folks who trade it a lot because it's not an easy thing to trade. Bonds do not necessarily reflect that the equity markets are going to be up and down. Bonds do not reflect only monetary policy. Bonds are not just some sort of recession, harbinger either. So it's all of those things, which is what makes it so difficult. So this is where today's event is going to be very interesting. We're going to get the rate cut, and then do we see the type of press conference and the type of rate statement that suggests we'll get one in December too? You might say, Rod, what does that sound like? I'll tell you what, I don't know. We never know what's going to come out of their mouths, and we know there'll be slight adjustments to the rate statement, but I do know that this is the magic decoder ring. This particular target rate probability graph. And by the way, everyone could go get this on the CME FedWatch tool. Just Google CME FedWatch and this will come up. All right. This is free data, amazing site from the CME. We want to see that middle column move up while the column to the right, the 450 to 475, move down. That is what we need to look at 2 p.m. and then again during the press conference, which will begin at 2:30 Eastern. All right. So this is your Federal Reserve, which really is the only macro that matters, as the great Stan Druckenmiller says. And this is what we'll continue to keep an eye on. So today's a caution day. The target rate probabilities factor in a fully discounted 1/4 rate point cut today. The drama starts with December, and that's where the clarity for March and June and March meetings, there's no February meeting, start to affect what's happening on ZB and ZN. And what we want to look at is whether the 10-year and the 10-year and the 30-year start to finally put in a floor, because when this chart's moving lower, rates are moving higher. And then ultimately, it's an inverse relationship, right? So when this chart's moving lower, rates are higher. When this chart's moving higher, rates are expected to be lower, right? I know, as if that makes a lot of sense, but that's the way it works. So it's inverse to the rates. So this chart in a downtrend, the long bond and the 10-year note also in a downtrend, suggests that both those yields continue to move higher and have throughout October and now into November. Okay, next up is, hey, how you doing, my friend? Yeah, sometimes I forget to put the charts on. We just have coffee. Good to see you. Good to see you. All right. I appreciate it. Good morning, everyone. Okay, so Jim has a question. How do you think about potential for follow through after a day like yesterday? Jim, I really try to assume one thing and one thing only, is that the markets will open. That's it. I don't know. I really don't know. I would not wake up thinking we're going to go the other way. What I'm going to wake up thinking is exactly what I told you. There is a reason to either follow through or pull back. And it really has a lot more to do with the 2 p.m. event. And I wouldn't be surprised if we're a little bit bullish, because we had this crazy day punching up to all-time highs again on the S&P. Let's not forget, all-time highs are not bearish, but a Federal Reserve that may not be as committed to successive rate cuts as we may have thought in July and August and even in September. That is not bearish, but that could trigger a little bit of a pullback, which, by the way, I would welcome. Rog, what are you doing today in terms of setting up trades, right? I don't know what the markets are going to do. Do I think they could follow through? Sure. But I do know the main event for us is going to be the FOMC. And I want to find those uptrends that if Jerome Powell kind of fumbles the ball a little bit, and I don't want to presume it's a fumble, but if he communicates a little bit less as dovish a sentiment as we're expecting, pull back and I'll look to buy the dip. So I'm kind of Rob, are you kind of hoping he sort of is unclear about future rate cuts? Absolutely. Otherwise, I can't buy things up here. All-time high in the NASDAQ, 21,000, right? I'm not bearish. We should not be bearish. This year has been a monster overall bull market, with a couple of 3 different times when there was either questioning whether or not the Fed should cut rates. That was April. We had a little bit more drama unfold. So we've had some drama unfold, but yet look at the resilience of the S&P and the NASDAQ to continue to punch up to all-time highs. And while the Dow has been lagging because of the weight of healthcare, which has frankly been a dumpster fire, the Dow doesn't have the same sector strength to power it higher. Think of the index as the motor, the individual sectors as a cylinder. The Dow's got a cylinder or 2 that are not firing: energy and healthcare. So while pretty much the NASDAQ has all cylinders firing, the S&P, because it's weighted more like the NASDAQ with that tech emphasis and financials, is able to overcome some of the laggy parts of those 500 stocks, which are healthcare and energy. But when you've got a 30 stock index like the Dow with weighting in healthcare and energy, it's a whole lot harder to dilute that lag in those weaker sectors. And that's why the Dow's just not keeping pace. Okay. All right. So let's see here. So that's, Jim, that's what I'm looking for. Yes, I would presume there's some follow through, but that's not a trade for me, right? I'm not just going to buy anything at the open. I'll look for long positions as long as we're above the previous session close, which we are not in the Dow, by the way, and we are on the S&P and the NASDAQ. So as long as we're above that previous session close, that line in the sand, I'll look for long positions more so. And I have a bullish bias. I do All of us tend to have a bullish bias. There's some folks who like to pick tops. Everything is a reason for a mean reversion. Everything's a precursor to a crash. There's no top that they don't want to fade. That's okay. That's one approach. I like to be long. I like to buy pullbacks. I do look at the history of equities. I do look at the history of post-election equities and say, gosh, what's the probability? Probably higher. That's 123 years of the election. And you might say, Rog, what happened here? That was the Depression. So apart from that, that was, that's your crash. But other than that, and nothing to do with an election, gang, the markets just are poised to move higher. But the person who holds the key to higher highs is going to be the person who's at the gears, at the helm of the monetary policy. And that's why 2 p.m. today is so important. All right. Thanks for the question, Jim. All right. Pierre asks, MU and Dell has worked out. Cool. Very cool. All right. Next up, PLTR. What's a good pullback level? Oh, gosh. On PLTR, Panthers, I'm not playing this at all. Momentum traders, I would say, this is where someone on this side of the camera and the mic should definitely say, hey, you know what? This is not the kind of symbol that I trade. It's not the kind of environment that I trade. This is not what I've built my career or even track record on. This is not my kind of symbol. So I would definitely run that by someone who plays momentum. The last opportunity would have been any kind of mean reversion. And we're nowhere near that right now, but I'll say, look for a retracement. So the best I can do is say, pull a 50% retracement for the minor low to whatever eventual minor high that we get. We still don't have one, and then look for a 50% retracement. So definitely not the kind of symbol that I would put on my watch list. So, it's not that it's bad. It's just not something that I would in any way be able to intelligently tell you what to do next. And sometimes I think it's really smart for some traders to say, you know what, not in my wheelhouse. And that's really it. Christopher Henry says, Christopher, if you have questions about what we're doing in the mastery, feel free to ask there. I'm not going to dive into it in Charts and Coffee. But yes, if you've gotten the alerts, you know exactly where we've been managing it. Take a look at the recap and the alerts in the room. And then you'll see what we're doing in terms of managing it. And yes, we absolutely, as we go to a first target, move to break even. As we go to a second target, we want to trail that stop, tighten that stop. Okay. All right. Next up is Reddit. Okay. That's another Momo name. It pulled back a little bit. So Brian, I'm not a momentum player. I know a lot of folks like things that are going straight up and, jumping higher and things like that. In this case, both these stocks benefited from, obviously some good earnings. But, your question's a good one to show you and Panthers what it is that I would look at in terms of the pullback I was referring to. So the best we can do, I'm not going to ever buy at a new high. That's not ever going to be what I'm going to recommend or what I'm going to do, right? If we get a little bit of a pullback, that's going to be an opportunity. Look for things to go on sale because healthy trends correct. Big moves see some profit taking. And into that profit taking, if it can last, 2-3 days, sometimes you'll have a good low you could take advantage of and then put yourself in a better risk reward position to take advantage of the move higher. Here's the important part. By buying the pullback, you don't actually need the equity, in this case, Reddit, the stock, to go higher. You can just take advantage of it, retrace the steps that it's already been willing to make. And that to me makes a lot of sense when I'm not in a position to have to need higher highs to take that first profit target. So that's what I would look at on Reddit. Look at something like what we saw. If you liked Reddit on the 30th and on the 31st and said, I don't want to buy into higher highs, you definitely should have loved it on the 1st or the 4th, right? So if you like it up at highs and it's a true trend, and this one is, even before earnings, beautiful trend. Then when it pulls back, that's where we jump into action, right? Okay. Next up is Costco. I haven't been, yesterday, I'll tell you a little story of Raghee putting on a trade that she really shouldn't have put on. So yesterday, I like the structure in Walmart, and you'll see where this kind of comes to head. I like the structure in Walmart. It's one of the relative outperformers. It's been in an uptrend, but it's in a dumpster fire of a sector, and that's the staples. Staples have been really heavy. Philip Morris, Altria, Walmart have been stronger, but they're in a weak sector. You know what happened yesterday? I bought an option for $1.10 and I got stopped out at 80 cents. It was a loss. And I will say it's not because Walmart wasn't in an uptrend. The hair is in my face. Sorry. It wasn't that Walmart wasn't in an uptrend. It was that it was in an uptrend in a sector with an outgoing tide rather than a flat slack tide or in a rising tide. And that was not an error, but it was a riskier trade. It was a slightly lower probability trade. Costco doesn't even look as good as Walmart. So I would say that's where the wheels fall off the wagon for me, Ren. I put on a trade where I found the strongest or the cleanest shirt in some filthy laundry. So Costco is not even the cleanest shirt. So be careful with that. Philip Morris, Altria, Walmart still have uptrends, but look at XLP, look at the group. Right now, with all-time highs in the NASDAQ and the S&P, staples are a defensive. Are defensives going to have a lot of flow? Probably not, right? We're going to see attention right back to financials. We're going to see attention right back to tech, the Mag 7, et cetera. So that's going to come right back into focus. So that's why I would say no, Ren, because I tried it with a really good trend, not even a so-so trend, right? And I would even call Costco a trend. It's mostly bearish, yeah, based on my indicators. And I tried it with that. I got stopped out. So I'd hate for you to put on a trade that has to work as hard as it might have to work to overcome that outgoing tide in that sector. And I did it yesterday in a really good one, and I still got stopped out. So, okay. And, look, there is a lot of expectation for stocks like Walmart to potentially move higher. It's been in a trend for a while, which means anything out there in terms of narratives. Why would Walmart struggle, say, in the new administration or whatever? Those are not unknowns. But I would say part of the volatility we saw was the extreme amount of weakness in staples, where stronger names like Philip Morris, Altria, and Walmart just couldn't keep their support within the typical volatility levels. All right. Next up is XLF. Questions on XLF. Megawatt, Scott. XLF itself is not a bad looking sector at all. It's actually one of my favorites. And here's the thing. When it comes to XLF, you'll notice there's a lot to like. JP Morgan, Visa, Bank of America, Wells, Goldman, Morgan. Those are my trends, right? Even Berkshire jumped up, but that was the rising tide of up 1,300 pre-market futures points in the Dow. The number one weighted sector in the Dow is XLF. So everything jumped, right? And that was a gift. We were long Wells Fargo into the election, and we took a $3 and change option to $10 and change. That's not trading. Let's not underplay the role of luck in trading, but let's not also underplay the role of how lucky you can get when you find and follow trends, right? Both things can be true. These are not trends in a sense that I love. I don't like big gaps. I don't like them at all. So let's see what the Federal Reserve does. Let's see where the dust settles, and then we'll go from there. But these are the names that I like the most in XLF, by the way, including XLF itself. So Megawatt, Scott, that's what I'm looking at specifically. So American Express, not so much. Berkshire, no. MasterCard, no. Citi, no. Chubb, no. All right. Let's take a look at semiconductors. And yes, gang, there's a number of things that, whatever the trends are. Here's the thing, gang. Nobody knows what's going to happen, and nobody knows fully what's being factored in. As if I know the narrative for everyone's reason to be long or short. However, if we follow the trends, this will reflect what we do and don't know, right? So we know semiconductors, they're not a bad looking part of the NASDAQ. My favorite is NVIDIA. I'll continue to look for opportunities in NVIDIA. In fact, our most recent closed trade in semiconductors was NVDA, and I'll continue to look at NVDA. But, I have to be aware of the overall environment within this sector, not as good as it could be. Okay. All right. Let's see here. And just like that, I'm out of time. All right, gang. That's a wrap. I will see you all tomorrow. Same time, same station. All right, gang. Be good to each other.